RBC Wealth Management's George Gero joins me now from the IPMI Conference in Phoenix, Arizona. George, I know you sit on the board of directors for the IPMI, so thank you for taking a break and speaking with me.
And thank you very much. I do have to make an announcement for COMEX. We started trading a 1,000-ounce silver contract Friday afternoon, and this would have been the great venue to announce it.
Absolutely. Well, thank you for announcing that with us, George. Now, let's talk about the recent events we've seen on the precious metals landscape. Did you pay attention to the last FOMC meeting?
Yes, I paid very big attention because since May 22nd, when Mr. Bernanke told the investment community that there's a possibility that the punch bowl was going to be taken away, markets have been very nervous, extra nervous. And last Thursday, after the release of the minutes of the FOMC meeting, the markets really took a tumble when interest rates jumped in the 10-year from 2% to almost 3%.
George, you've obviously been in this business. You've been in this business a very long time. Is this a pattern that you've seen usually emerge after FOMC meetings?
No, this is something else, and it could be a game changer to some extent because in the past, when the Fed changed direction and started raising rates, they would raise rates very quickly and by a lot more than people anticipated. This is what's spooking the markets today, and it may be an overreaction, and it seems to me like Friday afternoon, a lot of the market thought it was an overreaction, and we had some short covering in metals, and we had a little bit of an upswing in the stock market. After being down 600 points in 2 days, it was only down about 45. It was up 45.
George, where do you think we're headed? Do you think that it's inevitable that we will be heading towards higher interest rates and that might hurt the gold down the line?
Well, not necessarily, because as we have higher interest rates and we begin to see inflation, and Bernanke did say that he was in favor of 2% inflation, and we do see inflation, gold prices may tend to rise once again because inflation hedge is what gold is more important as for most investors.
George, in the past, I've read the comments from former chairman Paul Volcker, who said that there's too much reliance on the Fed to solve all economic problems. What do you think of this statement, and do you think that's true today?
I think it was true in the past, and it could be true, but today you have central banks acting in concert, and all that takes place is with all the central banks acting together.
So what do you think of the current environment now, George, for the metals? Are you bullish long-term on gold and silver?
Yes, I am, and I'm bullish long-term because I believe that there will be a recovery. The euro at 133 is showing signs of a recovery. There could be a good recovery in the Far East because bad news can become good news, and the Chinese PMI figures were not good, which means there could be stimulus in China. Also, stimulus, recovery, all that leads to higher prices later on.
But George, why would recovery lead to higher prices? When we speak of gold, we usually say that it performs well under financial crisis. So when you say a recovery would be good for the metals, can you explain why it would be?
Because investment demand will come with inflation.
That's simple.
It's that simple. I can paint a picture for you that last October, COMEX open interest in gold was 492,000, and gold prices were around $1,750 maybe. Today, open interest is 377,000, and gold prices are a little under 1,300. So that shows you that money left gold to go to equities. Now, if equities start to lose some money, it could come back to gold.
Excellent. George, thank you so much for your thoughts today.
Thank you again for having me.
And we'll have more coverage from the IPMI conference here in Phoenix, Arizona. You can email us in the meantime at newsfeedback@kitco.com or follow this conversation on Twitter at Daniela Cambone. Thanks for watching.